We're on the cusp of a regime change, David, as it relates to global coordinated central bank policy. Namely, during COVID, Bank of Japan has been the global liquidity provider by printing unlimited yen and using that money to not only buy JGBs and Japanese equities, but actually global sovereign bonds and global equities as well. They have now stopped their yield curve control. And in the context of that global coordinated central bank policy, both the ECB and the Fed know that they have to lift the torch so as to avoid a massive liquidity shock.
Thomas Hayes returns to the show. He is a managing member of Great Hill Capital, and he was on the show 3 months ago calling for stock markets to grind higher. He made the correct call then. Check out our interview in the link down below. We're up here to see what he said in January. Now things are starting to cool off a bit, so Thomas has this updated view for us today. What's going to happen next? Find out and stay tuned. First, a shout out to our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you're over 18 and you want to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below. Or if you're watching this on a TV, scan the QR code right here to get started. Thomas, welcome back to the show.
Thanks. Glad to be here, David.
3 months ago, you were calling for the markets to continue going up, and it has. But now we've seen a bit of a reprieve, about a 5% correction from the top from a couple weeks ago. What's going on right now?
Yeah, about a month, 4 or 5 weeks ago on our public appearances, we, as you know, appear on many different stations, started talking about a 3 to 8% pullback in the markets. And we set up two hedges that we discussed publicly. One was we did put spreads on the S&P 500, which was 1% of our equity capital, expected value of 5x. And we did put spreads on the semiconductor index, also 1% of equity capital. And we stayed long in the portfolio, 98% long with those two hedges. The semiconductor index now, peak to trough has dropped 17%, which most people aren't really talking about, although a few people felt it on Friday. So that's been a very successful tactical short and hedge for us. And the S&P is down 6% peak to trough. We did take off some of that last week on the S&P side. The semiconductor side, we remain short or tactically hedged. And we rolled that into long TLT, long bonds, which means we think that the rally in yields is coming or at or near an end.
If you're, I guess, long on bonds and expect yields to fall, are you then expecting the Fed to pivot anytime soon? Is that based on a reduction in the short term or short end of the curve?
It's not predicated on an imminent cut. However, I do think that it would not be outside the realm of possibility to see the first cut sometime this summer. I think the aspect that many market participants have failed to notice or are not paying attention to at the moment was something that was disclosed in the Fed minutes about a week and a half ago, which was that consensus was to taper the taper starting, quote unquote, soon. And this is a big deal because currently you have about $95 billion of bonds rolling off in the market every single month and not being replaced. So you have no treasury bid in the market from the Fed. As a result, the Fed balance sheet has come down modestly, but meaningfully over the last year and a half since they started quantitative tightening. Moving forward, if you've got 60 billion of treasuries and 35 billion of mortgage-backed securities, their focus is to at least start replacing half of the treasury roll-off, which means they're going to be in the market buying 30, 40 billion dollars of treasuries a month. Now, you can call that whatever you want, but the fact of the matter is there's going to be a new buyer in town, and that is a buyer of size, if you remember the size of historical quantitative easings, and that is going to create a bid for bonds that no one is really focused on at the moment. And as a matter of fact, the reason we say it's time to fade the spike in yields, the counter trend move in yields, is because that is expected to happen sometime in May by those in the know, and it's been alluded to both in their minutes and by several prominent sell side analysts.
If yields will fall, Thomas, are you expecting inflation to continue falling alongside with it?
Well, inflation, is really been impacted by insurance premiums, which are abnormally high. And I've spoken to people in the industry, and basically what you're seeing, I said, well, why are they so high? Because I've seen soft cycles that last longer than everyone expects. I've seen price hardening cycles that last longer than people expect. And the issue was during COVID, it was so hard to get, in the case of auto parts, auto repairs done. And then because it took so long and it cost so much, they would have to provide rental cars, and there was a small supply of rental cars. So the cost to the insurance company when someone filed a claim were astronomical. And we're now working through the tail end of that. So I do believe that heavy weighting of insurance premiums is going to start to mitigate, at least stop going up, and probably in the next few quarters start coming down. That's going to have a dramatic impact. And then owner's equivalent rent, we all know that's been a lagged indicator. If you look at Zillow and other rental indicators, that should start. It's taken longer than expected. So I do think that inflation, A, has moderated quite a bit, and B, continues to moderate prospectively.
In one of your recent hedge fund tips reports, and I'll encourage everyone to check out hedge fund tips down below, you have a chart showing the net percentage of fund manager survey investors who expect global profit growth to continue improving. And it's in the positive, and net 20% of FMS investors think profits will improve in the next 12 months. How does this translate to sentiment in risk assets, do you think?
Yeah, so sentiment had been for most of the rally. And, we've been bullish, not just since 3 months ago, but since October 2022. And then when everyone got bearish in March of 2023, we were bullish. And then everyone got bearish again in October of 2023, we were bullish. The first tactical short we put on over that period has been in the last 5 weeks. And as I said, we've kept the semiconductor one on. We think there's a little more work to do there. So as it relates to sentiment, what many headlines have been saying is managers are the most bullish since January 2022, which implies what happened in February 2022. We started a big correction, 25% correction in the S&P 500. And the error in that headline and that thinking is it's trapped in what we call recency bias, taking the most recent event and extrapolating forward in perpetuity. And what it doesn't have is a sample size worth exploring, which would be that the sentiment also reached these elevated levels in 2013 after the 2011 and 2012 European debt crisis, and the equity rally continued for another year and a half. And the sentiment that they refer to as a reason for a crash also reached these levels in late 2009, and the rally lasted for another year and a half. So we are, while we had been cautious starting 5 weeks ago, and it took longer than we expected. We thought it would be imminent in late February, early March to get this pullback that we've now seen. It took 5 or 6 weeks, but we're finding, we buy individual companies, we run a concentrated portfolio. We're finding things that we want to put money to work right now, even if we're not bottom ticking the indices. So are we saying, the correction's over, buy all the indices? No. Are we saying that this correction in indices has created some new crop of incredible opportunities to put money to work today, even if the market hasn't yet bottomed? That is what we are saying.
Well, speaking of sectors, you wrote in another report on hedge fund tips that the West, the Fed and ECB have stopped hiking and will likely move to ease in coming months. You've said this already. Point number 3, this will help interest rate sensitive stocks and bonds, EM equities, small caps, banks, REITs, utilities, etc. Are these the sectors you're mostly concentrated in?
These are areas that we're putting new money to work. We're on the cusp of a regime change, David, as it relates to global coordinated central bank policy. Namely, during COVID, Bank of Japan has been the global liquidity provider by printing unlimited yen and using that money to not only buy JGBs and Japanese equities, but actually global sovereign bonds and global equities as well. They have now stopped their yield curve control. They have now started, albeit modest, magnitude is less important than direction, started hiking and being more restrictive. And in the context of that global coordinated central bank policy, both the ECB and the Fed know that they have to lift the torch so as to avoid a massive liquidity shock. And they will do that. And I think it will be started by the Fed in May with a tapering of the taper, i.e. being back in the market buying bonds, although they'll call it something else, i.e. reinvesting those that have rolled off. And the ECB probably looks closer to cutting than the Fed, maybe simultaneously, but both soon in months, not years, for sure.
If the BOJ stops becoming the provider of global liquidity, so to speak, I wonder how that directly translates to liquidity here in the US and in North America.
Yeah, and I think that's why you're going to see the Fed back in the market buying, right now they're rolling off $95 billion a month in bonds, 60 treasuries, 35 mortgage-backed securities. And if they announce in May, they'll be back buying 30, 40 billion a month. That's a tremendous amount of liquidity, $500 billion a year. And to your point, and the question you asked earlier, the biggest beneficiaries will be the ones left for dead during that period where both all of the West, the Fed and the ECB, were aggressively restrictive, trying to crush inflation, which they've largely succeeded. Emerging market equities, I think, are going to get a bid that no one expects. I think that's going to help emerging market equities. It's going to help China. We're seeing signs of recovery in China. Finally, it's taken longer than everyone expected, or certainly longer than I've expected. Small caps will be a major beneficiary. Banks we're already seeing, REITs, utilities, all of that. The other thing that the Fed is cognizant of is the impact of the ability for people to refinance and the ability for people to buy homes. And they also have the dual mandate of employment as well as inflation. So yes, they want more data, but I don't think they have as much of a fuse as they think they have to wait for data, which is why I think you're going to see them use their other tool, which is actually more significant than a 25 basis point cut, which is actually creating $30-40 billion a month of new liquidity as a buyer in the bond market.
Just going back to sentiment as it relates to what you just talked about, I'm looking at two things. The VIX has been spiking, and the credit spreads have slightly widened. The Bank of America ICE high yield option adjusted spread is slightly ticking up from earlier this April. Are these two coincident indicators or leading indicators for anything?
I think they're more coincident. Certainly in the terms of the VIX, it's coincident. In terms of high yield spreads, you always want to keep an eye on that. This is probably more of when you see heart attacks like you saw in 2020, we had the recession. Then in 2022, by the way, we had a technical recession, first two quarters, negative GDP growth, which is why we got so bullish in October of 2022. And I said, everyone's waiting for the recession that's already happened. And that's persisted. Oh. It's unlikely that you're going to see 3 recessions in 6 years. On balance, you see, one every 4 to 7 years, somewhere in that neighborhood. And the fact that we're 2 for 4 years tells me this has a longer way to go. This is a normal, healthy pullback. This 6% in the S&P peak to trough, 8% in the NASDAQ, 17% in semiconductors. And I think it's closer to the end than the beginning. And we're seeing it in a lot of individual names, but the indices might show a hair more pain before inflecting.
Since we spoke in January, a few things have moved dramatically. The first is oil, which I'll ask you to comment on. Let's talk about energy. Are you keeping tabs on how energy is affecting the rest of the broad markets?
I am. We have expressed our energy view through a company that Jerry Jones owns about 2/3 of. He's the owner of the Dallas Cowboys. And he recently put another $100 million into Comstock Resources, which has a tremendous amount of natural gas in the Haynesville area, which has access to export out of the Gulf. So we like that. As far as individual energy companies, and we've known each other for a long time now, if you recall, in 2020, we were very aggressive buying integrated energy companies and E&P companies. We took a lot of those off after they had the huge run into 2021 and 2022. we haven't found a level of value and margin of safety that's attractive to us. We do think the secular trend is up. We do think emerging market demand is going to start to accelerate. But there could be some factors that put more supply back on the market over the next 12 months. If there are political changes, if there's geopolitical de-escalation. So we think the best way to play the increasing energy demand, both from AI, EV, all the population growth, et cetera, is actually to play it through natural gas, which is the most hated at the moment.
How significant is the energy price to the rest of the index? I've heard this narrative, and please comment on it if you can, that should energy break out due to geopolitical shocks or supply shocks, like you've mentioned, first of all, it may put the recession into the economy faster than some may anticipate. It may force the Fed to move faster than anticipate and ultimately have dramatic impacts on the stock markets themselves. What do you think?
I think if it's geopolitical, it's short-lived. And I think that if it's secular demand, I think there will be a political will to increase production and make it easier and easier for us to tap the deposits that we have. I think that if you see political changes as well, I think the relationship with OPEC could potentially be different moving forward. So it wouldn't surprise me to see continued strength, but we also are through a period of seasonal strength where you normally see a bid post-February into about now in anticipation of the summer driving season, and then it kind of tails off through August. So I wouldn't make any new big energy bets, other than playing the one expression that we have at these levels we like in terms of natural gas. And that's kind of a different framework to think about how to express it. And we're buying it at such a discount to its liquidation value that our margin of safety is great, irrespective of the price.
Okay. And the other one I wanted to bring to your attention is gold, as you know, run up to new all-time highs, surpassing $2,400 at one point. Thomas, are you concerned about what this signals? Well, not so much the price run itself, but is it signaling the risk off soon? Is it signaling heightened geopolitical pressure? Is it signaling some sort of credit event?
I think it's signaling more. We started this call talking about it's time to fade the spike in yields and the spike in the US dollar. And I think that the deficits that we're running, debt to GDP greater than 120%, I think gold is telling us that we need to get our fiscal house in order. And the irony about that, David, is the last time we had debt to GDP levels this pronounced, i.e. 120% plus, was post-World War II, 1948. And by 1956, they took the debt to GDP ratio down from 120% down to 63%. How did they do that? They let inflation run a little bit hotter, above trend, 3 to 5%, like most governments historically have done to pay off their debts. They inflated away. Now, how do you do that and yet at the same time pin inflation expectations so people don't start to behave in a way that accelerates inflation? Is you keep talking about this ethereal 2% inflation target, which will never happen. You continue to pin expectations down. You look at 5-year break-evens, they're being very effective with their hawkish talk, but they know if we're going to have some type of normalization of debt to GDP after borrowing so much money with regard to COVID and its aftermaths, they are going to have to run inflation a little bit above trend and at the same time maintain liquidity. They'll do a lot of it through the balance sheet. And as it relates to cuts, I think the name of the game with cuts is the earlier they move, the less they'll have to do. If they went with one cut this summer, they might be one and done, or one to two and done. If they wait till after the election, I think it's going to be problematic. And I think they're going to wind up having to do a lot more than they anticipated. And there's going to be a lot more pain to employment. So I'm optimistic they'll continue to talk hawkish. They'll get a cut in before the election. They will start providing $40 billion a month of liquidity in the bond market to compress yields. People will be able to refinance. Liquidity will be there. And as far as commercial, they'll work through with a natural extend and pretend.
Okay. That's great. So finally, I'd like to ask you about your positioning, long term and medium term. Ultimately, you haven't changed your tactical outlook since last we spoke, right? In March, in January rather, because I see in your hedge fund notes, hedge fund tips notes as of the 18th of April, you wrote that we continue to be hedged and long.
Yeah,
The answer is there's been the odds favor a short-term pullback, which we're getting, but none of our active positions are at or above fairly fully valued. And so we ignore the short-term noise. So
exactly. So we were able to benefit from this short-term volatility with those two tactical hedges because they were asymmetric bets, putting at risk 2% of equity capital with expected value of over 5x each. So we could dampen volatility, create some excess capital. And now we're looking for opportunities to deploy in coming weeks. There are quite a number of great companies now that have been marked down to levels where they're absolute no-brainers moving forward. So we like the environment. We're constructive. It doesn't preclude, a little further softening in any of these indices, but there's enough to do now constructively into year end that we would be starting to deploy money, not in indices, but in individual names.
thank you very much. All right, Thomas, where can we learn more about you? Follow your work and
Yeah, I think on Twitter, we have the handle is at hedge fund tips. On Instagram, we just set up a new handle at official hedge fund tips. That's a little bit more personalized. People are liking that. And TikTok is at official hedge fund tips. That's been a big one for us. And then the website, of course, hedgefundtips.com. And appreciate being on with you as always.
I appreciate you being on. Have you been getting bots on Instagram? Is that why you had to use the official handle and person?
Yeah. We've kind of got some coaching that different content works in different platforms. So we try to be a little bit more personal and share some pictures on the golf course and as well as some great market stuff as well.
Okay. Well, yeah, you write some great analysis on hedge fund tips. We don't have time to go over everything you've written in the last week, but I do encourage people to check it out. We'll put the links down in the description below. Thank you very much again for coming on the show. We'll speak to you again soon, Thomas.
Thanks again, David.
Thank you for watching. Don't forget to like and subscribe.